Hi, welcome back to Finally Revealed. In this episode, I want to talk about retirement plans and the three major kinds that there are. Well, four, but one is not used a whole lot. They are combined into two general categories. One is a defined benefit and one is a defined contribution. Defined benefit means the plan is based upon how much the worker will receive when they retire or become eligible for this pension, and it's commonly called a pension. It applies for municipal workers. It used to apply for companies back a long time ago, back in the day, but now it's usually teacher or governmental workers. We have judges that after they've served so many years, then they'll get a certain percentage of their salary at the time of retirement for a certain period of time. Same thing with teachers. After they put in 20 years, they will get a certain percentage of their salary. So that's a defined benefit plan. So it's based upon what the benefit is. And then the party that's paying has to work backwards, figure out present values of money, and put away enough in investments or whatever to generate the income so that they're able to pay those defined benefits when the time comes. Most people, unless you're in government or teaching, most other people are in a defined contribution situation. And it's whether your employer does it or you've created it on your own through your savings plan. And that's where you look at it from the now time and you say, this is how much I'm going to contribute now. 401k plans, and the worker contributes, maybe they can go up to 6% or 8% of their wages. They can contribute that pre-tax every month when they get paid, and then the employer will match maybe up to half of that. So if they contribute 6%, the employer will put in an additional 3%, and then that accumulates. That is a defined contribution. There are three kinds of generally recognized, and these are not all of them, the generally recognized defined contribution plans is the 401k, and that refers to a section of the Internal Revenue Code that makes this plan tax-free. The 401k is where there's not a limit as to how many employees you have to create one, but it's an obligation going forward that the employer, if the employee joins in and makes a contribution, the employer is saying, I will do it. And that starts from the beginning, and then the employee is vested in all the money they put in, and then they earn the money that the employer puts in based upon how long they work there. Then there is the simple, which is similar to it works the same as a 401k, but it's for when there are fewer it's for limited amount of employees, and the amounts that can be put into the plans are different for the 401k versus the simple, but they work under basically the same situation. The simple has fewer expenses of administration because it's for a smaller group of people. Then, and the idea being that the employer isn't a giant company that makes gazillions of dollars. It has a smaller, the numbers are smaller. Then there is a Sep, and that is a self-employment plan. That is a Sep Ira plan. And this again there are certain requirements as to whether you can do this. But this is a situation where it is discretionary on the part of the employer on whether they make a contribution or not. It's tied to the owner or owner group and what they contribute for their retirement. Then this is 100% employer paid. The employees, you can look at it both ways. They don't get to, but they also don't have to contribute out of their pay. It's all employer based, but the employer decides, and they don't have to do it every year, but if they decide for the owner or ownership group that they're going to contribute a certain amount, and this one has the biggest amount eligible, you can go up to, I think, 25% of the earnings for the year, an additional 25%, and it's tax-free. and it is put into the IRA family, whichever one they choose for that plan. And then if they do it for the owner or ownership group, they have to do it for the employees. And one caveat that's different from this, the 401k and the simple talk about full-time employees, the SEP covers all employees, including part-time. And so if they do it for the owner or ownership group, then they have to make the same percentage based upon their salary or their earnings of the other employees, and then that is invested. The difference between the SEP and then the simple or the 401k, I said the simple or in the 401k, the employee is vested in their own money at the beginning but earns the money that was put in by the employer over time. And in those situations, if they leave before they're fully vested in what the employer put in, then the employer's money gets divided among the other employees who are still in the plan. And then if they continue to work and they get fully vested, then they reap the benefits of someone who left. In a SEP, the eligibility period is when at the beginning, so you might have to work there a few years before you're eligible. But once you're eligible, it's all employer money, and once that money's deposited, it belongs to you as the employee. So defined benefit versus defined contribution. I hope that this helped you. If it did, give me a thumbs up. If you learned something, leave any comments or questions below. Subscribe to see the other videos, and please check out the playlist. For any business videos, check out the big brass and it's over here to subscribe to that. It's a featured channel, and come back and see me next time. Thanks for watching.